All right, what's up, guys? So for today's video, I'm going to be talking about something that I think is very important, and that's going to be the checklist that I use to find the stocks that I invest in, not trade, but invest in for the long term. Um, so first off, I should say that I take this checklist from a guy named Peter Lynch. He was an investor slash entrepreneur. He took over Fidelity's Magellan Fund, and he turned around 20 million into 14 billion in 13 years, which is a pretty good return. And he uses six things that he looks at in a company before he buys them. So for this example, I'm going to go over Vertex Pharmaceuticals, ticker symbol VRTX. I really like this stock long term. I think it has a ton of potential. Just based, I think it's actually very overvalued at the moment, or undervalued, I should say. Sorry, very undervalued at the moment. I think there's a ton of potential here. Maybe even in the short term. I'm looking at the chart and it doesn't look too bad, but um, yeah. So first things first, we're going to be talking about PE ratio. So that's the price to earnings ratio. And this is the share price versus the earnings that a company makes, like how much money they make, right? So sometimes people call this the price multiple. And a higher ratio, it can mean overvalued. However, you have to look at a couple factors. Sometimes in the industry that the stock is in, a high PE ratio isn't bad. And it also sometimes can mean investors are expecting this company to make like more money in the future. So something like VRTX, their PE is 22, so that means they're trading 22 times at how much they make, and that's actually not that bad. But if you look at something like GrowGen, which is something I'm very heavily invested in, you can see that their PE ratio is 666, so they're trading at 666 times what they make. And while that sounds very very bad, um, this is a very much a spec stock, right? So GrowGen makes like hydroponics and stuff, and with the hopeful decriminalization of marijuana with the new administration, this stocks like this and wheat stocks will thrive. So there's a lot to be expected here. They just made a couple acquisitions. They've got a good balance sheet, so people are expecting them to make a lot of money, and I think they will. But yeah, so that's what PE ratio is. It's pretty important. Back to Vertex. So next up on the list is institutional ownership. And this is how many shares are held by institutions. So if you didn't know, 2/3 of the market's total shares, like everything in the market, it's held by institutions like hedge funds, mutual funds, that kind of stuff. So the lower the institutional ownership, the better, right? And it means that the stock hasn't been found by institutions. It's kind of like a hidden gem, and there's more room to grow and more shares available. And the reason that there's more room to grow is because the institutions themselves will actually bid the stock price up by attracting more buyers, which raises the price, even more. It's just not a good look. Vertex actually does have a pretty high institutional ownership at 95%. That's very high. You usually want to. I think a good institutional ownership is like good is like 60-70%. Great is like 40%. And like anything above like 85 is like it's pretty bad. Not bad, but could be better. So yeah, so like I think Zynex, they have a very low institutional ownership, which is great. Like another spectacular long term company. I'll go over this in a second. But yeah, 35%. That's spectacular. Means they haven't been picked up by people, and they're pretty undervalued. But yeah, so next is insider activity. So this one's pretty simple. There's a lot of reasons why like a director would or CEO whatever would sell shares of his company, right? He might need like a new house or a new car, a new boat, or whatever. But the only reason an insider buys a stock is because they think it'll go up. So I just want to point out a couple examples of this. We all saw GRTS. This was Gritstone Oncology. They ran freaking massively the last couple days, and you can see that there's a big uh, insider buy on the 30th for $5 million worth of shares, and this was when it was trading at I don't know, not at $35 a share, around $3 a share. And yeah, it did spike up a little bit, but I missed this one. I'm kind of salty about it. But yeah, so that's one. Another one is a Root. This was one I actually did play pretty well. And you can see here that somebody actually this person, this 10% owner, not only did they buy a lot of shares, but they actually almost doubled their position, right? So they added 753,000 shares, and they had around a million before, so that's almost a doubling of position. That's big. It's big news, and they ran up massively. They ran up like 40% from there. So that's another good example of institutional or insider activity. Another good thing for this is stock buybacks, when like a company will buy back their shares. Like Netflix just announced that they would probably be doing this uh, during their earnings. GE's done it before. Facebook's done it before. Big companies do it a lot of the time, and it's good. So you want to look out for stock buybacks. Um, Next up is going to be earnings growth. So this is pretty simple. Again, it's just how much the company makes over years uh, in earnings. So this one's it could be better. They lost a lot in 2019, and it doesn't look like they're going to be making a ton in 2020. Um, but actually, they're probably going to beat. They're going to beat. It looks like they're going to beat in 2020. That's good. Yeah, you can see they lost here. They were up and they were up again. So you want to see this nice, even the revenues too, just nice earnings growth, and that's really really the big thing, right? You don't want to be investing in a company that's losing money, right? It's also nice if you don't want to see sporadic growth either. Like this was a big pump, but if it was like up here, like I'd be a little worried about that, but it's not. It's not that bad. So I mean, you can look at Zynex too. They've had some pretty good earnings. Yeah, this is just spectacular earnings growth. They from $69,000 to 7 million, 9 million, and they look like they're gonna do well this year too. Maybe not as good, but um, their revenues are increasing like crazy too. So that's really good. So yeah, so a strong balance sheet. So this is, I think personally, this is the most important thing. And you can find a balance sheet by going over to Yahoo Finance, looking at statistics. So what you're mainly going to be looking at is profit margins. So that's how much a company makes versus how much they spend. So let's say the company spends $1 and then they make $1.50 back. They have a 50% profit margin because they made 50 cents on that trade or whatever. So you want a good profit margin is usually, I would say, like, you want a really good profit margin like 20%. Like that's a really good profit margin. Um, and then you can talk about you got to look at EBITDA. EBITDA, yeah, earnings before interest, taxes, depreciation, and amortization. And this is a big word, but it basically just means a company spreading out loan payments over time. Um, so you want this to be good too. DE ratio, debt to equity ratio, how much a company is in debt compared to what they make. This is another one like PE ratio that you just need to look at the other industries and sectors that the stock is in, the other stocks in the industry and sector. Right, so a lot of times some industries require more debt than others, just because like energy and like oil, that's a sector that relies heavily on debt. But you usually want a debt to equity ratio around 1.5. That's a really solid one, debt to equity ratio. Return on assets is important, right? So that's profitability compared to the total assets of said company. Gross profits, how much they make, and then ROI, that's return on investment. That's how much you would make. That's how much return you would make on an investment in that company, right? So historically speaking, at least. So cash position is the last thing we're going to be talking. Actually, I'll look at Vertex really quickly, um, just to show you guys why I like this one. So right, you can see a 44% profit margin. That's really good. That's really really good. Really good return on assets. Really good return on equity. Um, Wait, what did I say? Yeah, not yeah ROI. Sorry, I meant return on equity. My bad. Whatever. Um, yeah, this is good. Their EBITDA is 2.78 billion. That's pretty good. Um, their their debt to equity ratio is pretty high, but they make a lot of money. So it's and their total cash per share is just insane. So it doesn't really worry me that much. If this was like 20, I'd be a little bit more nervous, but it's not. It's the current ratio is also pretty low. Like you want this around 4, and 3.72 is pretty good. So I would say this is not something to worry about as much. Um, yeah, I mean, also float isn't part of a balance sheet, but but you can look at float too just to see how many shares they have outstanding and how many are available for the public to trade. You want like 10 under 10 million is really good, but you're only going to see that with small cap stocks. Um, so yeah, and then lastly, cash position. So this is like the ground floor of a stock. So you got to look at like free cash flow, total cash. Right, free cash flow is how much cash they have on hand, like after everything. That's how much they're holding. Um, so usually you want their free cash flow to be like pretty high. So this is a pretty good cash flow compared to their total cash. That's a third of their total cash is a pretty good cash flow. You also got to talk about what trading below cash is. So this is when I talk about ground level. You want the total cash. You want the market cap to be above the total cash, right? You don't want a stock to be trading at less than how much they make, because that's not good. Um, but yeah, so um, yeah, I mean that's really it. I can go over some other stocks that I think have really good potential. Right, Zynex, I've brought it up a lot, but their earnings are really solid. They've gotten a ton of upgrades recently. Um, just looking at the statistics, 14% profit margin, good return on assets, good return on equity. Um, they don't have a ton of debt. It's kind of high, but it's not crazy high. Good cash flow. They were able to pay out a dividend too, which is really big. They do have a low float. But yeah, so that's what I would suggest you guys look at. Another reason why I like Vertex is, right, you got to look at how they spend their cash. So going back to Vertex, um, they don't pay dividends. So if they had a lot of cash and they paid a dividend, I'd be like more right with that. But if you're just holding cash, you're not doing anything with it, then that's not good. You're just wasting cash. But you can these guys, Vertex Pharmaceuticals, they're working on a lot of shit. They're working with CRISPR on literally curing sickle cell. They've got a ton of different drugs on their pipeline. They're all in phase 4. They're all doing really well. Um, they're working on a lot of stuff. So it's definitely a growing company, and there's a lot of potential here. But yeah, so another reason we can look at, there was some insider buying recently. Um, oh, there was insider buying. Yeah, a little bit of insider buying at 3 million compared to all the selling. There's a lot of selling, but 3 million is a good amount. But yeah, I mean, compared to like 8,000, 1,000, 20,000, 9,000, that's not a lot. But yeah, so that's what I would look at when I look for stocks. So yeah.